The second phase of the accounting process mentioned in the AICPA's definition of accounting is classifying. And that is what I am going to discuss and illustrate in this lecture series. In addition, I will also talk about the chart of accounts and trial balance and show you how to prepare an unadjusted trial balance from the balances of the accounts arrived at in the classifying stage. In simple terms, classifying means arranging in classes or categories certain items according to their similarities or shared characteristics. In accounting, classifying involves the grouping together of the same accounts which have been recorded under a designated account name in one place called the ledger. The classifying phase of accounting is commonly referred to as posting, which is the process of transferring the entries made in the journal into the appropriate accounts in the ledger. From this, we should know that whereas recording transactions, the first phase of the accounting process, is done in a book called the journal, posting, the second stage, is done in a book called the ledger. For that reason, the journal is described as the book of original entry, while the ledger is known as the book of final entry. Although you should already know by now that posting or classifying is not the last or final step in the accounting process. The ledger is said to be the book of final entry simply because it is considered as the final repository of accounting data. An entity may use either of the following ledger formats. Obviously, the advantage of the 3-column running balance format is that the balance of each account is updated after every posting of information because of this balance column. Nevertheless, for the purpose of illustration in this video series, I will be using this two-sided T-account format. It is called T-account format because it is formed from the letter T. Notice, this horizontal line and the vertical line in the middle form the letter T, with one side on the left known as the debit side and another on the right known as the credit side. Hence, the name of this type of ledger, two-sided T-account format. Let me illustrate the posting procedure using the journal entries which we prepared for Marty Medical Clinic. In parts 2 to 5 of my lecture series about recording business transactions of a service business. Assume that the account titles in Marty Medical Clinic's chart of accounts have these account numbers. By the way, a chart of accounts is a list of all the account names used by an entity in recording transactions, usually with their respective account numbers. Therefore, it serves as a guide for an accounting staff or even an accounting student to have an idea about the most appropriate account title to use when preparing journal entries. With the account numbers, he will be able to properly fill in the folio or PR or reference column in the journal after every posting. Moreover, from the order of the accounts in the chart of accounts, one will be able to know the arrangement of those accounts in the general ledger. In other words, each account in this chart of accounts must have its own ledger in the book known as the General Ledger. There must be as many ledgers in the General Ledger as there are accounts in the chart of accounts. Therefore, we must have a ledger for cash, for accounts receivable, medical supplies, and for every other account in the chart of accounts. Did you notice how the accounts are arranged in the General Ledger and chart of accounts? From assets to liabilities to the equity accounts of capital and drawing up to revenues and expenses. Current assets normally appear first before the non-current assets. I said normally because, as discussed in another video, the industry practices constraint allows some companies, like those in the utilities industry, to show their non-current assets first before their current assets to emphasize their large investments in long-term assets. If current assets are usually shown first before non-current assets, current liabilities also come first before non-current liabilities. Although in this case of Marty Medical Clinic, there are no long-term or non-current liabilities. Notice also the account numbers as they give hint or clue as to the type of an account. Here, for Marty Medical Clinic, current assets are all in the 100s. 101 for cash, 102 for accounts receivable, 103 for medical supplies. In case there will be other current asset accounts in the future, the accountant will most likely use 104, 105, 106 as he deems appropriate. Non-current assets are in the 200s. Current liabilities in the 300s, and the equity accounts in the 500s. So obviously, the accountant of the clinic is reserving the 400s for the non-current liabilities. Each revenue account has an account number in the 600s, while expenses are in the 700s. Of course, in real life, entities design or tailor their chart of accounts to the operations and nature of the organization and assign account numbers or account codes as they deem appropriate. Account codes can actually be numeric, alpha, meaning letters of the alphabet, or alphanumeric, that is, combination of numbers and letters. Thank you for watching.